Now here is the Oppenheimer Developing Markets Fund. This is during the recession that occurred early in the decade. If you start on the left-hand side of this fund, as the fund was going down, our investment system was not in it. And then, as it looked like we were starting a new cycle, our system bought in. And then we stayed in until it looked like we were going over the top of the cycle and heading down, so the system automatically bought out or sold out. So now our portfolio was sitting in cash, gaining some interest, while the actual fund continued to complete its cycle on the downside. Then, as the cycle started coming back up early in October of 2002, then we can see that the system bought in again. But now, instead of having to spend our time trying to get back to even, you can see that we are going to be starting from a much higher level where our cash position left off. So what would this exact same fund look like using our system over the last 10 years? You can see that $100,000 in the year 2000 using our system would have turned into $597,000. Had you simply bought this fund and hung on to it for that 10 years, you'd only have $189,000. But if you look closer at the chart, the dark blue areas are when we actually were holding the fund. So you can see when the chart is dark blue, usually the portfolio is going up because we are owning the fund as it's going up the positive side of the cycle. And as it goes over the top of the cycle and starts going down the other side, you can see that it turns into light blue, which depicts our cash position. So as the fund, which is in the light blue squiggly line, as it goes down, our fund position is light blue, sitting in cash, gaining just a little bit of interest, waiting for the next cycle to occur. The S&P 500 over the last 10 years, $100,000 invested in 2000 turned into $80,956 by 2010, which would be a loss of about $20,000 or nearly 20%. Our system, utilizing two different asset classes, starting with $100,000 in 2010, would have actually turned into $409,000 by 2010. A dramatic difference. And again, you can see the cycles, the dark blue, as we were catching the proper side of the cycles and sitting in cash on the downside of the cycles. Now, whenever you're investing, you want to let the winners run and cut the losers short. So what does that mean? When our system buys in because it believes we're starting a new cycle, the average profit was a 16% return over the next 110 market days, which is a little over a quarter. But sometimes we get head faked. Our system buys in because it believes we're in a new cycle, but bad news comes out or something changes, and all of a sudden we just bought in and the market is going the wrong way. It's going down. The system then sells out, and on average we only lost 3.5% over the course of 21 days. So it sold quite quickly when we were wrong, but it holds when we're right. And we're only right about 50% of the time. So success in investing is not doing one thing right, it's doing a whole bunch of things right and letting it all accumulate. Now, why is it so important to cut your losses short? You can see that if your investment declines 10%, you have to make 11.1% to break even. Well, that's not such a big difference. But if your investment loses 50%, which people did twice in the last 10 years, you have to gain 100% just to break even. If you think about it, if you have $100,000 and you lose 50%, now you only have $50,000. You have to double your $50,000 or earn 100% just to get back to your original $100,000. And that's why so many people are still trying to get back to even. Our systems are designed to never lose much more than 10%, because you can see that if you lose only 10, you only have to gain 11 to get back to even. Our system is very easy to start using. We replace the need for those allocation funds in your 401k. You no longer will need to pick the funds yourself. We will tell you which funds you should currently be in, and we'll let you know when you should change your allocation based off of when the market changes. You receive the same exact statement. You access your account the same way as you always have. Nothing changes in your account. Here's how we work. Once you sign up and become a member, you'll receive a username and login. So you go to your member page, and it'll show you what the positions are you should currently be invested in. Then when a change occurs, we send an email alert. You then log back in and find out what needs to be changed. Then you simply notify your 401k administrator online or call the 800 number to make the changes. So in review, this is the S&P 500 versus our system. The S&P 500 being in the light blue. You can see that there are two major bars going down on the S&P 500. In 2002 it lost 21%, and in 2008 it lost 35%. Our worst case scenario is we lost 5% in 2008, but we actually gained 8.7% in 2002. Now those were the bad years. The recovery years, we also completely outperformed the S&P 500. You can see in 2003, which was the recovery from the earlier recession, the S&P 500 did 21% while we did 45%. In 2009, the S&P did 21% and we did 55%. So if you look at that in actual money, again, $100,000 over the last 10 years in the S&P 500 would have turned into $89,000. But in our system, it would have turned into $409,000. So which would you choose? So go to ewatch401k.com and start protecting your 401k today.